Hey everyone, welcome back to the channel. We've got quite a bit to cover in today's recap, from Boeing's latest financial maneuvers to ongoing production challenges and upcoming earnings reports. Let's dive into the details. First up, Boeing is taking some serious steps to raise as much as $25 billion in capital. This money will provide crucial support as the company faces a combination of labor strikes and production delays. On Tuesday, Boeing filed a shelf registration with regulators, which essentially allows them to sell a combination of bonds and shares. This move will give Boeing access to cash when needed over the next 3 years, helping to stabilize their balance sheet and avoid a downgrade to junk status by credit rating agencies like Moody's and S&P Global. Now, why is this important? A downgrade to junk status would increase Boeing's borrowing costs significantly, making it harder for the company to secure favorable loans. This is a big deal for a company already under financial pressure. To give them more breathing room, Boeing has also secured a $10 billion credit agreement, providing additional liquidity in the short term. According to the company, this credit line will help them navigate the current challenging environment. Now, let's talk about the ongoing strike situation. Boeing is currently facing a paralyzing strike at its Seattle area facilities, where union workers have halted production for weeks, demanding higher wages and pensions. With this new financial firepower from the bonds and credit line, Boeing is hoping to strengthen its bargaining position. However, negotiations have stalled, and there's no sign of the strike ending anytime soon. And that's not the only problem Boeing is dealing with. The company is also grappling with quality issues on its 737 MAX jets, a model that has been under intense regulatory scrutiny since the infamous grounding back in 2019. In addition, Boeing has delayed its 777X program yet again, pushing the launch to 2026. This wide-body jet program has already been delayed for 6 years, and the latest setback only adds to the company's woes. Bloomberg recently reported that Boeing could be considering a capital increase of at least $10 billion, which would be the largest by a public company since Saudi Aramco's $12.3 billion sale in June of this year. If Boeing goes ahead with this plan, it would help the company avoid a credit downgrade, for now. But as credit sites analyst Matt Woodruff pointed out, the ongoing strike and operational setbacks mean Boeing's credit rating is still at risk. As he said, this buys them a little bit of time, but not much more. Boeing shares have risen slightly, less than 1%, as investors weigh the pros and cons of these moves. While raising capital strengthens Boeing's balance sheet, it also dilutes the value of existing shares, which has already contributed to a 43% loss in stock value this year. That's the second worst performance in the Dow Jones Industrial Average. Boeing's new $10 billion credit facility is an important lifeline, but there are strings attached. The company has 120 days to draw on the credit, and any outstanding loans must be repaid within 364 days. What's tricky is that if Boeing taps into this credit line and then raises capital or sells assets, they're required to pay back the loan immediately. This means Boeing has to be very strategic about how and when they access this credit facility. The shelf registration provides Boeing with several options for raising funds, from selling common and preferred shares to issuing senior and subordinated bonds. But the goal here remains clear: stave off a potential downgrade from both Moody's ratings and S&P Global ratings. If those downgrades happen, Boeing's interest costs would soar, and it would become less attractive to investors. The strike is proving to be incredibly costly for Boeing, with estimates suggesting it's losing over $1 billion a month. And that's despite the company's efforts to cut costs, including a plan to reduce its workforce by 10%, which translates to about 17,000 jobs. This is Boeing's worst year since the 2008 financial crisis, and it's clear that the company is in damage control mode. Boeing's troubles don't just end with the strike and production delays. Earlier this year, a freak accident involving a 737 MAX blew a door-sized hole into the fuselage mid-flight, forcing the company to slow production even further. This incident was another blow to the company's already fragile reputation. Despite all these challenges, Boeing still has some positive long-term prospects. The company has a backlog of 5,490 aircraft, which could generate around $500 billion in revenue once production ramps up again. And let's not forget, Boeing is one half of the global duopoly in large commercial aircraft, alongside Airbus SE. Airlines and leasing firms have few alternatives when it comes to buying large jets, which gives Boeing a competitive edge despite its current struggles. Looking ahead, Boeing is set to release its third quarter earnings report on October 23rd. This will be the first time that new CEO Kelly Ortberg presides over an earnings release. Boeing has already announced it will take a $5 billion charge related to its defense and space divisions, as well as additional costs from delaying the 777X yet again. So it's clear that Boeing's troubles are far from over. So what do you think? Is Boeing going to bounce back, or are we looking at more turbulence ahead for the aerospace giant? Let me know your thoughts in the comments below. And don't forget to hit that subscribe button and turn on notifications so you never miss an update on the latest aviation news. Thank you.